Hello everyone, welcome back. Patrick here. In this video I'm going to teach you how to sell covered calls on your SPAC positions. So I do this all the time. To me it's like free money, and this really helps you maximize your returns, especially on some SPACs that are trading sideways or down. You guys know that before the merger often there's like a couple months where really nothing's going on with the stock. Often it's starting to lose share price and everything. Well, that's a great opportunity to actually sell covered calls and generate some cash flow using them. So today I'm going to show you how to do it, when not to do it, and if the market goes against you and the share price starts to go up, how to adjust your position. So I hope this really helps you. I think you're going to enjoy it, and it's going to help you get to the next level as an investor. You always want to maximize your returns and limit your risks. So please like and subscribe. I think you're really going to enjoy this one. Let's get started. All right, friends, quick refresher. When you sell a covered call, you need to have at least 100 shares. 100 because each contract is worth 100, meaning if you have 500 shares, you can sell 5 contracts. If you have 10,000 shares, you can sell 100 contracts. So this is the minimum, and this is not going to work with warrants, only shares. You can adapt this strategy to almost any stock in the stock market that has options attached to it. But in this video, I'm going to focus only on SPAC covered calls because of my audience, and also the timing is a little bit more important. So when you sell a covered call, you are giving someone the option of purchasing your shares at a certain price. That's called the strike price, within a certain time frame. That's the expiration date, and we have to keep track of those two variables. They're very important. In exchange for that, because if the share price goes up, someone is going to be able to buy your shares, so you have to be compensated. Well, you're going to receive what's called a premium. The premium is the amount of money that you're getting, and this is going to be very beneficial because you're going to be able to use that money and redeploy it in other investments. Plus, it's going to lower your cost basis in the stock that you own, right? So this is very beneficial. Now, the premium value is going to depend on many different factors. So we're going to look at some of them later, but one of the important ones is the amount of volatility in this stock. And SPACs are considered very volatile, so the premiums are usually fairly high, which is one of the reasons why I do it and I like it. It's good for cash flow because the premiums are higher. As opposed to when I do it on, let's say, silver with the ETF SLV, that instrument is not as volatile, so the premiums are much lower. So more volatility, more premium. And last but not least, when you're doing this, like the best strategy is when the stock is going sideways or down slightly. Like when I'm filming this in February, most of the SPACs right now are trading sideways or a little bit down, right? They're not shooting straight up. That's when the strategy works well. If the stock is going like up very quickly, then this is not the best strategy at that time. So we'll cover that too later on in the video. All right, so this is going to be a great example for you. This is IPOE SoFi. You guys know that I really like this stock. I do think that long-term it's going to be a great wealth builder. So I have a lot of warrants, and then on those I can't sell covered calls. But recently I started to buy some shares in my different accounts, right, at $25. Well, if we look at the chart, you guys can see that it's now in this phase right now, which I call the retracement phase before the merger. Like once it reached its peak, slowly it kind of starts to drift down for a couple of weeks while we're waiting for the merger announcement, right? So currently, as you guys can see, it's in a small downtrend. It's trading in this channel, right? And I bought at $25. Well, what I could do is just leave it in my account and wait. But then, like, I would be losing a little bit of money every day. Currently, it's down 82 cents today. Instead, what I can do is sell covered calls on it, recover some of my money, and get some cash flow. So that's what I did. In this account, I only have 200 shares, so I was able to sell 200 contracts. So if we look at it, well, let's analyze it very quickly. February 19th is the expiration date. After February 19th, these expire. So if it's under the strike price, which is $35, then these expire worthless. I just keep the premium and I don't have to sell my shares. Now, $35 is the actual strike price. So for me to, quote unquote, lose my shares, be forced to sell, the share price would have to reach $35. So as you guys can see, I sold these very far out of the money because of that volatility that we were talking about. SPACs are notorious for going up and down in price very rapidly. So I wanted to give myself a very good cushion because I want to keep these shares long long term. So I sold them very far out of the money, and still I was able to get 53 cents per share. Now, this doesn't sound like a lot. I understand that, right? 53 cents out of $25, but it's not the real amount that matters. It's the percentage, because 53 cents per share, right, amounts to a little over 2% for 2 weeks. So if you annualize that, that is an amazing return on shares that otherwise would just be losing value every day for now while we're waiting, right? So if you do this on all of your positions, and if you always grind and maximize your returns, that's how you're going to have that snowball grow much quicker than others. And that's how you're going to get those outsized returns. So in total for these 2 weeks, right, I got $103.97 for these 200 shares. So again, it's not necessarily the amount of money that matters, it's the percentage, which 2% is excellent. Let me give you guys some examples of these SPAC phases and how to time your covered costs properly. So this is NGA Lion Electric. In the second phase, which is when they announce the merger, people discover the SPAC, and all of a sudden the share price starts to go up as people buy it. Well, with NGA, it peaked around $35, right? But all of a sudden there's no more buyers, the share price starts to retrace every day. Now, if you didn't have a stop loss, or for some reason you didn't see it coming, or you didn't think it would drop that much, let's say you thought it would drop from 35 to 30, well, you didn't want to sell, right? No one could have predicted that it would go down to 23. So for whatever reason, you got your shares and now it's losing every day. Well, you have to do something. If you sold covered calls, you would have sponged off some of those losses. You would have cushioned it, right? So not 100%, but you would have recouped some of it, and you would have generated some cash flow as it was coming down here, right? So let's say that you bought at the very peak, $35, but you're selling a $1 covered call, then all of a sudden, instead of having a $35 cost basis, you're at $34. And then if you do it the next month, then you're at 33, 32, 31. Up until a certain point where the share price is going to stabilize and hopefully go up, and at some point you're going to break even. So this strategy allows you to lower your losses if you're losing, or make more profits if you're winning. So that's why the strategy is great. You need to learn it if you want to progress to the next level. Now let's look at Microvast THCB. Very different type of graph here, but still the same principles apply. So this would not have been a great spot, even though the share price was drifting lower every day. The thing is that they had announced a letter of intent, so we knew that there was going to be a merger coming. We just didn't know when. So since there was going to be a share price spike when they announced the merger, you wouldn't have wanted to sell covered calls here. But after the spike, right, when it started to go down, now you enter that phase where it makes sense. Now, if we look at GIK, Lightning E-Motors, this one's a little bit more complicated, but now we're going to start going into when not to do covered calls. So here, they announced the merger, start to go up. You don't want to sell here. We reach the peak, starts to go down. This is a great period. But look at what happened here. Now, all of a sudden, people expect that there's going to be that announcement for the shareholder meeting. So this is the third phase retracement. Now we're going to enter the fourth phase. So as soon as you see that the trend line is breaking, that's when you need to exit your position. And I'm going to show you how to adjust, right? So this is great while it's going down, but when it starts to go up, you don't want to be selling covered calls. And another example of when not to sell covered calls is CCIV, for example, when it's going up very, very rapidly. Well, this is going to go against your position. So here you would have bought calls, or you could have sold puts, but not covered calls. Well, that was a lot of theory. Now let's go into the practice. How do you really do this in real life? So I'm going to go over this as best as I can. If you have questions, leave them in the comments. I'll do my best to explain it to you, but try to follow along. So this is NGA's options chain. If we look at the top, you see all the expiration dates, and then you can see all the strike prices. So the strike price, reminder, is the amount of money the share price needs to get to before I'm quote unquote forced to sell, which is never going to happen. I'm going to show you how to adjust it. But in theory, if you didn't do anything and it reached that price, you would sell your shares for that amount. Now, I'm going to go with the March 19th expiration date. It's about 1 month away from when I'm filming this, right? And then I'm going to look at the strike prices. I'm going to look at the different prices of what people are offering and asking for them. And I'm going to try to figure out what's the best risk versus reward for this play. Now, what do I know about NGA right now? I know that the share price has gone from 35 to 23, and I know that we're getting closer to the merger. They haven't announced the shareholder meeting yet, but we can expect that within like the next month, the next 6 weeks, the share meeting is going to come at some point. So now I have to figure out like, well, what's the best way to do this? Within the next month, once they announce the shareholder meeting, it's very possible that we go from the third phase, where the share price is going down every day, to the fourth phase, where it starts to recover, maybe it's stabilized, it starts to go up a little bit. Now, we don't know how high it's going to go. It could stop at 25, 28, or maybe, if we're unlucky, it keeps going down. But the point is, there is that very real possibility that within the next month, the share price is going to start recovering. And we know that covered calls, we want the share price to go sideways or down. So here, I'm going to go look at the strike prices. And if I take the strike price at $25, I mean, that might not be the best risk versus reward, because if the share price goes from 23 to 25, my position is going to be at risk. And that is very likely over the next month. So I'm going to have to go a little bit further out. If I go to, let's say, $35, well, all of a sudden, that position is going to be a lot safer, because for me to have to sell my shares for 35, the share price would have to go from 23 to 35. That's a pretty big increase over the next month. It is very possible, right? With SPACs, you know that they go up very rapidly. But still, that gives you a very nice cushion and a lot of time to adjust your position, which I'm going to show you how to do it. So here you are. Let's say that I go with $35. I could collect 80 cents per share at this time. Let's say that I have 100 shares of NGA. That means I collect $80. I lower my cost basis by 80 cents per share. Now what? Well, next I'm going to set a stop loss on it, like I do with all of my other positions. This is one of the hedges that you can use so that you don't lose your shares. What we're trying to avoid is situations like these, where Lightning eMotors has been going down. This is a great opportunity to sell covered calls, but all of a sudden they announce that the shareholder meeting is going to happen within the next month, and then there's a big spike in price as people are starting to get back into the stock. Well, this would threaten your position if you didn't have a stop loss in place. The goal of the stop loss is to close your position automatically as soon as the share price starts to spike like this. So it's going to look something like this. Let's say I sold my covered calls on NGA and I collected 80 cents for them. Well, here I would go buy close, right? So if I sold, now to close the position, I have to buy. So one, because let's say I sold one contract, 35, call. Then I would set the stop on quote at, can be $1, can be $1.25, depending on how I'm comfortable about the price going up very rapidly or not. And then I would do quote good for 60 days. Then I'm going to set the order. And then as soon as the options start to go up because the share price go up, it's going to close the position automatically. Now, it is possible that one day overnight, it's going to spike in price. Let's say it goes up by $2, right? So then you're going to be like, well, wow, my options are going to go up in value, so I'm going to lose that $2. Not really, because remember, in this case, we're selling very, very far out of the money. So even if the share price goes from 23 to 25, this is not going to really threaten your position. So your shares are going to gain $2, but the option might go up by 30 cents or something like that. And then if it reaches 125, it's going to close your position automatically. So with covered calls, people are very worried about losing their shares. But if you adjust your position and if you set a hedge with the stop loss, it's very, very unlikely that you're going to lose your position. And this is one of the safest strategies you can get. Like, that's why the rewards aren't amazing. I mean, we're talking about a couple % here and there, but over time, like when you add all of it up, that's when you can see like real differences in your bank account and your portfolio. All right, guys, in the close, one last thing I want to show you is how to adjust your position if things go against you. Like, let's say that you didn't have a stop loss, which I really recommend that you do, but let's say that you missed it for some reason. All of a sudden, the share price starting to go up, and now your position is in the money, right? You would lose your shares, you would have to sell them. Well, you want to keep it, so you have to do an adjustment. This is how it's going to work. Let's say that I sold NGA covered calls at 22.50 that expire in March 19th, right? So right now, as of me filming this, the share price in like an hour went from $23 to almost $24. So these options are in the money right now. I would be forced to sell for $22.50, but I don't want to. I want to keep these shares. So what I'm going to do is trade time for premium, meaning I'm going to close this position at a loss. Right, I'm going to buy it back for $4, and then what I'm going to do is open a new one further out in time that's at least $4, and this is going to offset my loss for the current position. So let's say that I open a position for April 16th, so 1 month out, at $25, so higher than the current share price, so out of the money, right? Then let's say that I can collect, here it says the last one was $4.30, right? So I would collect at 30 cents credit for rolling this position out 1 month. So there's a lot of adjustments that you can do like these. You can roll out your position, roll up, roll down. Like, I can't cover all of them in this video. You'll have to do more research on your own, or at some point I'll make more videos about it. But this is how you would do it. That's why I was telling you guys, you never really lose your shares with covered calls if you know what you're doing. Between the stop losses, between adjusting your positions, as long as you learn the basics, and I showed you some, hopefully it helped you, you'll know what to do. You can just keep doing this over and over again. Let's say that next month, right, instead of being 25, the share price keeps going up. Let's say that it's at $28 or $30. Well, what I could do is keep rolling this up. I could roll from $25 to $30, and maybe like the share price went up $5, and maybe I would lose $1 by rolling up my position. But once again, I keep the shares, and I can just keep doing this over and over again until at some point the share price stabilizes, and then I'll collect the full premium and I can close my position. So once you learn the basics, it's fairly easy to do. I hope this helped you a little bit. If you have questions, write in the comments. I know it's a lot to absorb, but you know, you have to learn somehow and you have to start somewhere. So I hope you guys enjoyed. Let me know what you think. I'll see you guys in the next video.